Good afternoon. Let's talk about your credit. Recently, we put out a post talking about how up to 35% of your credit score is derived from your repayment history. Today, we're here to talk about what would derive 30% of your credit score is capacity. So, what is capacity? So, we're going to talk in terms of revolving lines of credit, specifically credit cards. So, capacity falls into the variance between what the credit limit is and the balance you carry. So, let's take an example and find out what capacity is. So you have a $5,000 credit limit and you've maxed out the card or you've come close to maxing it out. You have little to no capacity. So your credit score is going to be pulled down by that. Let's take that same scenario and you have that $5,000 credit limit, but you now have zero to a small balance. Now you have greater capacity. So that's going to lift and help and improve your credit score. So how do we manage capacity? There's a couple of different ways. Now, number one, we've heard it from our friends, our family, social media, anybody who talks about credit cards. Credit cards are the root of all evil. They are villainous. They are considered the bad guy. What I'm here to tell you is they are a very good financial tool if used responsibly and in moderation. So, but the first thing is responsibly. Don't go and spend a bunch of money on credit cards unless you absolutely have to. They are there in the case of an emergency, or they are there for small purchases. You want to be able to, again, hit that 35% marker of repayment history. If you go put a tank of gas or buy dinner on it and pay it off, you're going to get that nice repayment history building up. If you're also using it in the sense of putting that tank of gas or buying dinner on it, you're more than likely not hitting even close to your limit. So you're going to be working within your capacity and having good capacity, which again is going to help and improve your credit. Where credit cards turn into the root of all evil, according to your family, friends, and social media, is when we go out and we spend a bunch of money on them. Now, we know life happens. Car breaks down. Let's say a transmission blows and it's $2,500, $3,000. Not a lot of people are sitting on that kind of cash. They got to be able to get the car so they can get to work. Follow the line here. Things happen in the house. Medical bills come up. If you got kids, you got sports, you got clothes. I mean, they're essentials that can come along and disrupt the normal pattern of life. And therefore, you have to utilize these financial tools. So what happens when we start to see those balances creep up? We have to cut them off as quickly as possible. You can do it in a couple of different ways. If that minimum payment is $50, but you can afford to say pay $250 on it, that's a way to do it. So you can make chunk payments. Another path is get it off the credit card altogether and put it into some sort of an installment loan. That will restore your capacity. Don't close the card. It'll restore your capacity. And you'll be able to then put your debt that was once on the card into an installment loan. And you could run that out anywhere from 1 to 5 years, depending upon the balance, and get it on a fixed path to being paid off. And you're probably going to save in regards to interest as well. So other paths are monitoring your limits. So let's say you don't have a balance issue and you don't need to make chunk payments and you don't have to put it into an installment loan, but you're still getting hurt on your credit because of capacity, because maybe you are still on the card you had when you got out of high school or college or started your career and they gave you 500 to 1,000. Or maybe you're in a situation where you had a life incident that hurt your credit and the first card you could get coming out of that incident was a $500 to $1,000 limit. When you get a couple years down the road, your life situation has changed. What does your income look like today compared to a couple years ago? And what do your spending habits look like? Your responsible spending habits look like? And does the card make sense? Now, I am not a proponent of closing cards. It happens, but we'll talk about in another post in another episode how having a long history with a specific card and company can really improve and help your credit. So closing a card out is not not necessarily the answer unless we are in dire straits. But we want to be able to have cards that grow with us. So and I like to use the example of the person that might be in their early 20s or the person who's coming out of a life incident. And the further you're removed from that beginning point and your income and life situations have changed, the credit card needs to change with you. Not so you can go out and spend a lot of money on it, but in order to fit the capacity need. Because now all of a sudden, maybe you went from a small car to an SUV. Anybody that's made that conversion knows that filling up the tank costs a lot more. Maybe your life situation has changed. Maybe you're no longer single. Maybe you have a lot more friends and family, kids, whatever, maybe a spouse, and you want to go out to dinner. You're not just going to fast food and spending $5 or $6 anymore. Maybe it's going to cost you $50. Your life has changed, but you can afford it. So why should your poor credit limit continue to drag your credit score down? And this is where you need to have a conversation with your financial institution to raise your limit. So by raising the limit, say you have that $500 card and you spent $400 on it, well, you can pay that $400 off every month, but maybe it doesn't get reported in time and it shows on your credit report that you have that balance. That's not helping you. But let's say you had a $2,500 limit and you still spent that $400. Your capacity is not damaging you at this point. Your credit score is not being damaged because you have a low limit. So let's just recap real quick. So obviously the best way to control capacity is let's not spend on the card unless we have to. But we know that life happens. So when life happens and you have to do it and you have to make a significant purchase or you need it to get by for a month or two, how do we handle the balance? So we start to get that bigger balance. Can we make chunk payments and pay it down quickly and not do anything with it? That's a possibility. The other way is let's take that balance out of the revolving debt, which is the credit card, and move it into an installment loan. And we can run that out 1 to 5 years, depending upon the balance that's being moved over, and that'll get you on a clear path of payoff. And then the other side is maybe I don't have a balance issue, maybe I have a limit issue, and maybe I'm still in that $500 to $1,000 limit card, and it's dragging me down every month because I spend $400, but I pay it off every month, but I'm still getting hit on capacity. So maybe I need to request a $2,500 or $3,000 limit. So the main points are, if you've got a balance, get it off the card and get it into something fixed. If it's not a balance issue, but it's a limit issue, talk to your financial institution, because again, that beginner's card you got straight out of college or out of a life event may not fit you a couple years later, and it's time to evolve from it. So with that, stay tuned for more episodes or more posts coming. We're going to talk more about your credit score, but just a quick recap, up to 65% of your credit score is derived by your repayment history and by your capacity. So if we can control those, we'll control your credit. Thanks, everybody.